Hey everyone, so today we're going to talk about the VIX and how that relates to the S&P 500. Now the VIX is a measure of volatility, so it's actually called the Volatility Index, but a lot of people as a slang term call it the fear index or the fear gauge. It's kind of a misnomer. I would think of it more of the uncertainty index because what it tells you is it tells you volatility, and it literally tells you the implied volatility for the S&P 500 index. What that means is it's looking into the options market, looking at the options on the S&P 500 and implying a volatility of the underlying instrument, in this case, the S&P 500. So by looking at the VIX, you're basically looking at a prediction of the future volatility of the S&P 500. What's interesting is the relationship between the VIX and the S&P. They tend to have an inverse relationship. So if the VIX goes higher, stocks tend to go lower. When the VIX is coming down, the S&P tends to go higher. Let's look at the chart. We can see that relationship over the last couple years. So here we're looking at the S&P 500 on the bottom, the VIX on the top, and we're looking back over the last 3 years or so. Now, I tend to think of the VIX in terms of what I call volatility regimes. Volatility kind of settles into a certain range, and it'll be there for about 6 to 9 months, and then something will change. It'll be a change of character for the market. So you can see on the left side of the chart the big spike higher in volatility. That was during the February to March 2020 market sell-off. When that happened, you see the S&P at the bottom rolled lower aggressively. VIX spiked higher into the 80s, one of the highest readings in history. From there, it settled into a range around 20 to 40. Then in 2021, the entire range came down. We went between around 15 on the lower end, around 25 on the upper end. Then as we entered into 2022, really the fourth quarter of 2021, the VIX once again became elevated. We were at 20 on the lower end, 30 to 35 on the upper end. Now let's look at the movement in the VIX over the last 6 to 9 months, how that relates to the S&P 500. When stocks are going lower, like in January 2022, you can see the VIX tends to go higher because when markets sell off, investors are tending to panic. They're tending to have elevated fear. Elevated fear means elevated uncertainty. That means elevated volatility as people are nervous about what might be happening in the future. So volatility increases as the S&P goes down. When the S&P moves higher, you can see that volatility decreases because we tend to be a little more confident that things are going to get better. And as a result, tension tends to be alleviated. Fear tends to subside a little bit. Look in particular at the relationship between the peaks and valleys in stocks and the peaks and valleys in the VIX. When the S&P hit a peak in late March or in early February or in late January, or early January, late December of last year, you can see the VIX was at a low, right around 20 or a little below. When the S&P sold off, you can see the VIX spiked to around 30 to 35. So very simplistically, if we just buy when the VIX goes above 30, if we sell when the VIX goes below 20, overall, we've ridden out 2022 very, very well. Here's the catch. It's all about the range. So going forward through the remainder of 2022 and beyond, it's all about this relationship and whether this boundary holds. Does the VIX hold above 20? Does it hold below 35? When one of those breaks, that tells you this relationship is starting to disconnect and we may be entering a new volatility regime. So by looking at the movements in the VIX, we can have a great sense of what that means, what that implies about the relative movements in the S&P 500.